Well, welcome back to Wealth Mavericks, the only show where we talk about the secrets the wealthy know and the government won't tell you. On today's episode, we're going to talk about the roles and guidelines of the financial distributors, aka how the banks, investment companies, and insurance companies all work.
There's two sides to every coin. Somebody can't lose without somebody winning. Somebody can't win with somebody not losing. There is that balance.
They've classified these things in a way that, and the little that I know about, alternative assets and some of these things, like they're actually more secure, they're safer, but because they sit outside of what you can do, it feels like this unfair game that I think is really interesting. So before we dive in, Bob, what's going on in your world?
Hey, Joe, I'm excited for this episode. It's the changing of the weather. We're getting into the winter season. And so it's a great time for year end and beginning of a new year for us to kind of assess what we're doing and why we're doing what we're doing, not just to do things, but have purpose and meaning. And so I love this time of the year, but just because that changing of weather kind of encourages those actions that we should be taking.
Yeah, for sure. I feel like this season, and you've mentioned it because it's a busy season for you.
Yes.
I think of like the Grinch whose heart grew 3 sizes, or whatever. It's like, this is your time to shine. This is where you have such a big impact. So it's fun to see that. I know we were coming back from San Diego, visiting family to Denver, Colorado. And man, we like drove through the seasons and it was like nice and sunny, and then we got back and it was like 26 degrees and it hasn't warmed up since.
Wow.
So yeah, we're definitely in that season. So well, we're excited about this episode, talking about all about the financial distributors. You have a ton of knowledge on this. You actually have presented a lot to people, and so I'm excited to hear what you've got to share today. What do you feel like is going to be the biggest takeaway from people today after listening to this?
I think a lot of this is just, it goes back to what we've talked about and we will continue to talk about, is just understanding the assets that are out there, understanding the rules to what we do in our day-to-day life. We do things so subconsciously, right? When we get up, we flip the switch, lights turn on, right? We go turn on the water and to wash our face or our hands, there's water, right? We don't have to go to the well. We don't have to light a candle or oil lamp or anything like that. And so we do so many things subconsciously. And the finance world and what we do in actions with our money is the same thing. And so I think it's really important for people to understand the basics, the rules of those assets that we all are participating in kind of the roles. And that's why I created the terminology financial distributors, because they're distributing financial products for you and I to use. And why? For what purpose? What are we using them for? And we should kind of know that and what's that meaning for us and what we're trying to accomplish.
And I haven't heard you give this presentation before, but some of the little that I know about it, like a lot of these things, their genesis is like hundreds of years ago. Some of the principles even thousands of years ago. Correct. Or not thousands, but probably 1,000 years ago. And the foundation of those things really kind of dictate a lot. And so if we really understood like where I had a friend one time told me, if you trace back every insurance product, it all goes back to Lloyd's of London. And I was like, well, what's that all about? So there's some, I'm excited about our conversation today. So enlighten us, Bob.
Yes. Well, I will say definitely we will not talk about the origination of fiat currency and that sort of stuff. There's been some great YouTubes and some people who've spent actually quite a few hours presenting the history of money. One of the gentlemen, Robert Breedlove, does a phenomenal job. He like you, he's got long hair, wears it in a ponytail, but just he does.
This is a man bun, man. This is not a ponytail.
Sorry. Well, clearly I don't know that. That's a language not in my vocabulary since I barely have peach fuzz. But this is really going to be more focused on to what your point is that Roman Empire, before Roman Empire, right?
Mm.
How did early civilization trade, and how did they pass goods and services back and forth? And today, right, we have the advantage of all of that history. And then, of course, technology has allowed us to either improve or reduce, depends on the side of the line you are, of these particular products and the goal for them. So some of the things we'll talk about, you may hint a little cynicism for me. Absolutely, you may have that as well. And then some things you're gonna hear from me, you're gonna go, wow, okay, yeah, that makes a lot of sense. And why aren't I doing that? Right? How come
Mm.
no one's talking about that? Because boy, that really talks and speaks to me of what I want to try to accomplish. But my advisors and the people in my circle actually don't talk about that.
Right.
And so I think that's what was so motivating about this. This is why I added it to our farming assets course. Is this is a baseline. This is in my book, Economic Termites. This is my book, Farming Assets. This is a foundational conversation that I think every person should know. We should have been taught this in high school when we were learning economics. Right? Supply and demand, absolutely. That's by far one of the most important things. But what about all this?
Mm-hmm.
So
right. That's great. So, when there's a book that came out years ago, I think it was just called Money. And there were some concepts in that book that I thought were really interesting, even like when even in modern times, like economies have shut down for lots of different reasons, and trade still happened. And there was even people were trading on perception of somebody else's wealth. Like, yeah, I'll take your word for it.
Yeah.
So there's some interesting concepts that I think that we'll talk about today. So
yeah, well, one of those to touch on that, this is kind of, I don't want to say it's a pet peeve of mine, but it's definitely something I personally think, my opinion. And let's do a disclaimer: we're not giving any investment advice, right? We're not telling you what you should be doing, what you shouldn't be doing. This is just for educational purposes only. This is just to give you information, cause those question marks to pop up, allow you to do a little more research. Your research could be emailing us questions and engaging us more. Perfectly fine. But this is not giving any guidance or direction of what you should be doing with your money.
Right.
Okay. So one of the things that pops up all the time, and I think back in the day, gold, precious metals were very valuable in exactly what you were saying, the ability to trade, right?
Mm-hmm.
If currency went away, how do I trade value for value? And that's what the history of money is talking about. Is money today as we know it is backed by the value of the United States government or the central bank, which is the Federal Reserve of that particular country.
Mm-hmm.
Right? They're the ones that actually print it and back it. That's why when you have countries that fall flat on their face with high inflation or whatever the case may be, they got to do a reboot. We in America had to do that as well. And so you have to do a reboot and start all over. And what value does that currency have? So people today want to talk about going into precious metal, going to gold, going to silver. It's a hedge against the markets. Well, gold and silver is no longer a tradable currency. It's no longer a tradable value. And I'll explain why I say that in a second, because it has now become an investment class. Because it's hedging the other investments. So let me give you.
What does that mean when you say it's become an investment class? You mean because people are investing like in non-real tangible metals, and that's so it's creating a value around it, or what do you mean?
Yes and no. Yes, because you could buy mutual fund of precious metals, a gold ETF, right? You're not holding physical gold, but then you can go and hold physical gold. But if our currency, to your point, if our currency dropped, went to zero, what value was your gold? And are you going to trade a gold coin that is worth $1,200 based on before the currency dropped, that you purchased it for $1,200 per ounce? Are you going to trade that for a loaf of bread?
I'm not.
Nobody will. Because
it's got a substantive value. That I actually saw a thing about this. Somebody was talking about the value of a gold ounce, basically a gold coin, and they said, if you think about it, it might have been Patrick Bet David, I think, was talking, or it was either him or someone on his podcast talking about this. And they said, in Roman times, a gold coin would have bought you a tunic, a belt, and a nice pair, and sandals.
Mhm.
And he goes, think about that today. $1,200, a nice suit, a nice belt, and a nice pair of shoes will cost you about $1,200.
Yeah.
So the value of an ounce of gold has not really changed. And yeah, you're never going to go trade for a loaf of bread because that's not that valuable.
Because we still understand what we gave up and sacrificed for that ounce of gold or that.
Yeah, good point.
Right. So the value in our personality, our mentality is it's still this. A loaf of bread is worth $2, $2.50, whatever it is.
Right.
Now,
the problem is I don't want to break off a piece of the gold coin and go, well, I'll have, this is worth 2 loaves of bread, or shave off some gold.
Right. So what would really happen? This came up with a dialogue with my wife and I. Right. She said, hey, I've been listening on the radio and news, and I think we should probably think about this. What do we do about this? Right. Because she's listening to it and she's worried, and there's some fear there. Mm-hmm. And I posed this to her. I said, fine, if we go buy gold, everything goes to what? I said, what are the most important things if the economy drops, what's the human nature going to do? Steal.
Right.
Steal what they don't have. So we have to have things that puts us in a position not to go steal what we don't have. So we need to have food, right? We need to have storage of water. We need to have some sort of supply of energy or heat or something to keep us, if it goes down in winter, how do we stay warm and not freeze to death in our house?
Right.
And then the other thing is, how are we going to protect it? Right? Because other people maybe have not been in a position or thought about storing this type of stuff. So how are you going to protect what you already thought about? Okay. And so do you have those protections in place? Do you have a plan in place? And then after all that chaos and craziness, what value are you to the rest of your community to continue in a very, let's say now third world situation?
Mm-hmm.
We all have to have a gift, a trade, or something to barter to be part of now the tribe, the community, to continue to survive and thrive.
Right.
Because even if, let's say, you have guns and ammo and that's your protection, eventually you're not going to have ammo. Where are you going to get more ammo? So that gun just becomes, it's less valuable than a rock.
Right. Or equally, maybe.
Or equally, right? You get one chance to throw it. Where pistol whip somebody, I don't know, right?
Right.
I mean, at that
tie
time,
it to a stick and use it as a.
At that time, a spear will be more valuable.
Mm-hmm.
Right. So, I mean, obviously, we're kind of going to grandioso thought process, but that's the whole point of this is let's think about assets. Let's think about what we're doing. Let's not emotionally go and do things off emotion. Now, you can feel emotionally compelled to do something, which is human, but let's have a logical plan in where to guide, where's the direction of that emotionally driven purpose that we have, because there's a lot of power to the human spirit when we're emotionally purposeful. Right. So that leads us to, okay, today, modern times, right? So we have these products, we have these services, and these financial distributors, so to speak. And so if you're on our YouTube channel, you're going to be able to see this. You'll be able to see my screen here. If you're not and you're listening to the podcast, Joe and I are going to do the best we possibly can to be very descriptive of what we're talking about and what we're seeing. I don't think it's going to be very difficult, but at the end of the day, if it becomes at least you can go to our YouTube channel and see the presentation from there. It's going to be the same words because it's the same presentation.
Because that's how it works.
All right, so let's kind of go into this and talk about it. So financial distributors, first of all, what are they? Or really, it's a company or institution that offers financial products. Wow, that's groundbreaking, right? But at the end of the day, that's what a financial distributor is. It's just like a food distributor is a company or institution that offers food products. It's basic English, right? Now, what's the purpose of each of these? Well, you got banks, right? So banks are one of them, investment companies are the other, and insurance companies. So you think about this, think about your life. When you have bills or you get your paycheck, where does that money go to? It goes into a bank. If you have revenue in a business, where's it go to? It goes in a bank. It doesn't go into an insurance company. Your check, your revenue doesn't get deposited into an investment company. It gets deposited into a bank. Okay, that's the system. Now, there's a whole system around banking and rules, and we'll talk about that in a second. Now, once you've done that, then you can decide, hey, I got money, I'm going to put it in X, Y, and Z. Well, X, Y, and Z could be an investment company, and we'll talk about what that looks like. And there's a whole world of rules around that. Or you can say, hey, you know what? Let's say we're a business owner and we got to protect our product, our business, our whatever we're doing. Some states require insurance for workers' comp for employees. You have health insurance, right? There's a bunch of different lines of insurance that we have, and that is to create protection. So when we look at banks, it's really designed for leverage. What is leverage? Lending. Right? And when you think about it, the Federal Reserve that prints money allows banks to have certain liquidity on that money. Banks can trade between banks, lend short-term lending with a rate, and that is what the Federal Reserve lending rate is. It tells the banks, here's what the baseline charge, period. So when the rates go down, money's cheaper. What does that mean? That means we have access to more money. It creates liquidity. Okay. And that's too much liquidity can create inflation. Too little can create deflation. So there's a fine line that the Federal Reserve chairman is responsible for. By the way, the Federal Reserve is not a government entity, though we think it is. It is a separate corporation. The Federal Reserve chairman is appointed by the president, which allows us to think that it's a federal, and they treat it as a federal, but in its bylaws and its sole purpose, it is a separate corporation. And the reason for that, it gives them the ability to set up and use laws, tax laws to their advantage, such as setting up entities and shifting money and protecting money and risk management using the way the corporate law in the United States works. Okay.
Right.
So leverage.
And people joke about that, the Federal Reserve is as federal as Federal Express. It's like,
right?
it's its own company.
Yep.
But it is interesting that there is this appointing process for that, where it almost lends credibility to being it being a federal, entity, which it's not. And I think there's some interesting elements here, when you look at the manipulation of, the rates and what that's doing in our economy and really impacts the average American's day to day.
Yeah.
So you're right. I don't know if we're going to talk much about that leverage element, but the way that our banking system is set up, and what's the term where they can they can lend $19 for every $1 that's in the fractional reserve,
Yep.
all of that. So I think there are some really interesting elements just around the banks.
Just around the banks. That's right. And I am of belief that the United States politician, whatever their background, whatever side of the aisle they sit on, I don't believe that is something should be appointed. If it is a separate entity, a separate corporation, it should have the ability to have the ability to hire their own leader, because the Federal Reserve is broken down into multiple locations around the country as a risk management tool. And there's directors, so to speak, and there's supervisors, so to speak, of each of those areas. And to the point you were bringing up is that if we have a Democrat in office and they appoint, well, what's everyone going to think? Any decision they make is going to be based on that political line of thinking, or vice versa. When a lot of times it actually could be the best thing for the country. But we're not going to think that because it's appointed by that particular politician.
That's really interesting. Like, if it was just an entity that was set up to thrive on its own, then it would always be making the decisions that are, well, probably in its own interest first, and hopefully that's directly aligned to ours.
Right. Which you would think that is what's happening now. But because is not completely severed or separate, we can't think that.
Mm-hmm.
We have to think that, wow, why is he doing that? That doesn't make a whole lot of sense. Now, they have more data than we do, right? Even in this time of information, they have more data than we do, that they're hopefully making decisions based off of that. But little old us, what do? We make emotional decisions and comments and thought processes that when they take an action, it's based on politics a lot of times. Now, if you're
Right.
not political and you don't think politics, then guess what? You're not going to think that. You probably don't even know who the Fed chairman is and that they just said something or did something.
Right.
And that's okay
What
too.
how often do the Fed chairmans change? Do they tend to change with each administration change?
No, no, and that actually is the surprising thing is that, and that's where we can have solace in understanding that, well, maybe they are not political, right?
Right.
Because you can have, or it could make you think that, all right, well, maybe this Republican is a what they call a rhino, right? And he's making is a decision. And then all of a sudden you have a Democrat in and they keep the Fed chairman. And then you're like,
They're all playing on the same team.
right, right. Now it's
Right.
that us and them. Right.
Right.
And back to the point where it really should be something that the political environment should not be appointing such an important position. They don't appoint the CEO of Amazon
Right.
or they don't appoint the position of any of the Walmart or any of the large corporations that you know are the top corporations in the world.
Mm-hmm.
So what gives them the right to appoint this
Mm-hmm.
if it's a separate entity? So anyway, some just food for thought. Again, it's just interesting. When we look at investment companies, it's risk-based. And I'm going to show you guys websites. I brought up websites this morning, live websites that were from this morning to kind of prove some of these points. So you don't think it's, oh, well, what's Bob talking about? I'm talking about what research I have done, where I have gone to it, and giving me this insight is like, wow, okay, now I have a better understanding of these rules. And so investment companies, when we talk about investment companies, we're talking about the whole world where we can go and as a company become a public company. We basically say, you, the public, can now own shares and be owners of our company, right? And there's this entire industry of investment banks and investment companies and all these rules, the Security Exchange Commission and Federal Trade Commission, all these different entities and acronyms are part of, but it's all based on risk reward.
Mm-hmm.
Okay. Is that a strong term? It actually is not, because in the investment world, they talk about risk tolerance. They talk about allocation. They talk about diversification. Those are all tools and terminology to minimize risk. Now, I love Warren Buffett's definition of risk, where he basically says risk is you not knowing the decision you're making. But if you know and you've done the research and you've looked at what you want to do and you make that decision, it's not really a risk. You have a knowledge base. Now, that being said, there's risk in everything. Of course. Of course. Right. Now, the level of risk varies with everything. So this is important to know. And then insurance companies, safety. We're using insurance companies to create protection, to create a security, a safety net around whatever that is. Plain and simple. And each of these have different products and services. So like banks, right? We have, of course, a savings account, checking account. They have certificates of deposits called CDs. They have loans. You can get personal loans. You can get mortgage, right? They have all these products to lend out. Whose money are they lending out? Deposits. When we deposit money, they use that money to lend out to your point earlier. How are they taking $1 and fractionally turning it into 10? Okay.
Right.
Now, whatever, just like the government, when they collect taxes and they have a larger spending budget and they need more money than what taxes they collect, what do? They go borrow. What do you do as an individual? You use your credit cards. When you wanted to buy your house, what'd you do? You went and borrowed the money and got a house, right? We don't live in an all cash society to where Dave Ramsey wants you to pay for cash for everything, right?
Mm-hmm.
That's not reality, because most people, by the time you save up the cash, inflation has caused that thing that you want to purchase to now be unattainable.
Mm-hmm.
Why? Because everybody else is doing leverage. Leverage is what helps charge inflation. Okay. Same thing with investment companies and same thing with insurance companies. So investment companies, we talked about stocks, bonds, mutual funds, ETFs. There's a whole other world of alternative assets and investments within this realm. There's things that are registered, things that are non-registered. What the heck's that mean? And right. So it's an entirely different world, but it's all based on the risk.
Right.
And also, as you as an individual, what kind of income do you make? What kind of assets do you already have? Are you separated into the two categories of what's called an accredited investor, meaning you have a certain amount, you can make riskier decisions with your money and have access to a different world? Or are you a non-accredited investor where you don't have the same criteria as the accredited? You don't have access to those things because they're quote unquote too risky for you. Right. So the government creates these guidelines as the whole to protect everybody. But at the end of the day, it's you and I that really should have the ability to say, I want to do this. Now, we don't, because when the decision doesn't go our way, what do? We call an attorney and we sue them and say they didn't do what they said they were going to do. So we have to have these rules and these separations and these guidelines, right? Because we don't hold ourselves accountable. With a law system doesn't say, shut up, stop whining. You made this decision, live with it.
Right.
Right.
Which I think it's interesting too, because your average person, your non-accredited investor does have access to unbelievably risky, like 100% risk products, like options in the market or whatever it might be, even some of those unlimited risks. So I think it's interesting that it's like they've classified these things in a way that, and the little that I know about alternative assets and some of these things, like they're actually more secure, they're safer, but because they sit outside of what you can do, it feels like this unfair game that I think is really interesting. And I've also found, like, when people talk about risk, and you have like risk profile questionnaires and things like that, and it's like, well, how tolerant are you, your risk tolerance? I'm like, I found that most people, when they lose their money, they found out they were really not so risk tolerant.
Yeah, exactly. Right? Because what do they say in sports? Winning solves all problems, right? The locker room's always great with winning. But the moment the losing starts, what happens to the locker room?
Right. Morale goes down and people are getting blamed and all kinds of stuff. Right.
So you brought up something that I found very interesting. You had indicated, and I'm going to pick on you a little bit, Joe. So hopefully you don't mind.
I don't mind.
You've got tough skin. I know. You got a man bun.
I think that's maybe not then.
Oh, sorry.
A samurai bun, maybe then I would be tougher.
We got to edit this out. So here's the interesting thing. You brought up the terminology option trading as being something that's risky. Now, let's think about this. If you and I have access to a stock, we have unlimited risk to what we put our money into. So if we put in $100,000 as an example, and we buy a stock, what's at risk? 100,000. Right? Now we're like, well, it probably won't go down to 100,000.
Right.
Well, if the company goes bankrupt, like Enron or WorldCom or any of the other companies that we had go under, maybe it could.
Right.
Right. But because we don't think that based on what logic, oh, it's a big company, right? Lehman Brothers had been around for how many years? Right. And just overnight. Right. So all of a sudden we look at this and say, okay, we're willing to do that. Now, it will make it safer if we put it in a pool of investments called mutual funds, right? Where we own multiple companies and our 100,000 is spread in shares of all of those. And that creates safety.
Right.
And then ETFs do something similar, just a different structure, right? And so now we think, okay, we're okay. You're not. You could still lose money when the markets go down or whatever the case may be. You could have great companies. What happened in the financial crisis? You could own companies that were very profitable, but because the environment was a negative environment, what happened to your investment? It went down. You have zero control. So what is risk management is trying to have a better understanding of what risk I'm taking in minimizing that based on my knowledge. So let's go to option trading. What is option trading? Now, you can make it very risky, but the very basics and core of option trading is you're buying a contract for a premium amount that is predetermined, with you thinking that this stock company, as an example, is going to go from $10 to $15 in this period of time.
Right.
And so all you do, you don't buy the whole stock. You don't take your 100,000 and you invest your whole 100,000 into that stock. You pay a premium, a smaller amount, for a contract that says this stock is going to go from $10 to $15 in this period of time. Pretty knowledgeable. You know the baseline. So what is at risk? What if it doesn't hit $15? What do you lose? Do you lose your 100,000? No, it wasn't invested in the company. What do you lose? The predetermined premium you already agreed to and understood for that contract. Why is that risky? It's not. You know what you're getting into from the very get-go. It's actually safer than going to buy a stock just right out. Same research.
Yeah, my scenario was essentially betting that the market, the S&P, it was actually the SPY, so a fraction of the S&P was going to be going down. So that was the specific option that I traded. Unfortunately, it was I think it was like a 3 or 4 week option, and I had a friend who believed that he kind of was timing the market properly, and candidly, so I put $7,500 into it. That $7,500 had actually gone up to $16,500. It happened on election night when Donald Trump was elected. And so the markets were going like tanking. So if I had sold when he said to sell, which was that day, it would have been worth, it would have doubled in value in a very short period of time. Instead, Trump won, markets turned around and went berserk crazy, like up. And so all those options became worth $0. So it's like, well, okay, there it went.
Yeah. And you lost the money you put in, which was 7,500.
Right.
Right. Now, again, like I said, option trading can turn risky depending on the strategy and puts, calls, and leaps and all this other terminology. It's an entirely separate world. But from just the baseline of what we're told, it's risky.
Right.
But you know what you're going to lose. You knew exactly what you were going to lose. You were willing to lose that until you did. You were willing to lose that with the promise or the opportunity or the potential to make more money.
Right.
That's a you decision.
Like
we should all have that.
more. Right. And I think that's my point is like, so why is 100% risk or a possibility of risk? Like you said, if I had just invested in the S&P, it actually would have gone up in value. So if I had put that $7,500 in, it would have gone up when Trump won. I felt like it was going to go down. So I thought, I was just betting on, again, this is not something people should do. Like timing the market is not a thing.
Right.
So why are those tools available to your typical person, but these, you have to be an accredited investor for these super risky, what's more risky than 100% loss?
Exactly.
Yet I have access to it.
Exactly.
So that's what I'm saying. Like to me, it doesn't make sense that there's rules that set it up that way.
Now we got to go back and be cynical and say who benefits from these rules.
Yeah. Right. Good question.
Right. And so that's why the rules exist. When you put money into a retirement account, 401k, IRA, Roth, whatever it is, when you put money into that, where's that money going? It's going to stocks, bonds, mutual funds, ETFs. It's going into this world with 100% risk. Right. And what are we told? Go invest in for your retirement. And we're going to give you a tax benefit, a carrot, to create you emotionally driven and logic at the same time, because I want to reduce my taxes and save for my future. And I get a double benefit from that to risk 100%. So when the market goes up, right, winning locker room, everyone's happy. We're all buddies. And then when it goes down, I don't like my advisor. Why is it doing this? Right? Locker room is disrupted.
Right. Right.
And so, but that's the point of a lot of this, is that just, it doesn't mean you don't do it. It's just, you got to know the rules to the assets of why and who's benefiting from it. Right.
Yeah.
We can actually flip this around to where you actually benefit from it. Right. And that's the whole point. There's two sides to every coin. Somebody can't lose without somebody winning. Somebody can't win with somebody not losing.
That's
there is that balance.
Tony Robbins' book, Money, Master the Game, he talks about that. Money is a zero-sum game. If you won, somebody else lost, and vice versa.
Yeah.
And his whole point, I don't know if you've read that book, but in it, he's talking about, you're playing against the best of the best of the best. And I promise you, they are not losing.
No, because they have algorithms. They have the money to back them up, because why? They know the history of everything, right? They built the algorithms. They know the prediction, right? It's Facebook with money, right? When you start talking about something, all of a sudden you get ads in Facebook. Well, hang on a second, right?
And his whole thing was like, he said there was a company that invested $250 million to increase the infrastructure from, I forget what city it was to what city, but it was like to put fiber optic network so that they could get the data a fraction of a second ahead of everyone else. A fraction of a second. That's what they're playing with.
That's right.
They'll invest $250 million to increase just a fraction, and you think that you're going to go out there and trade and win? Nah, like
but I got a Schwab account. What do you mean?
Right. I should be. I got it, man. I know what I'm going to do.
I read this book.
Right. If you've ever played, I've played sports with a few people who are just standout athletes. And the truth is, if you are not on their level, it's not a competition. Right. My dad and I, this is the best. My dad and I, he was a great racquetball player. And so and I didn't know anything about racquetball, but it was a ton of fun, right? I was super athletic. This is when I was in college. Actually, no, I think Mandy and I had just gotten married. And so my dad and I are playing racquetball together. And he was so confident. My dad is not a betting guy. Like he does not bet. But he goes, Joe, if you beat me, I'll give you the deed to our house. And I was just salivating. I'm like, okay, let's go. Because again, my dad's, a lot older than I am. He's not in great shape. I was in phenomenal shape. And so we start playing racquetball. Bob, he beat me 21-0. And that was him being like generous. I mean, it was like I was running like a rabbit around the court, chasing the ball. So when you've played a sport against somebody who's that much better, it's no competition. When we go into the markets and we think we've got this hot stock tip that's going to cause us to be the next best trader, you're playing against pros and you're in like T-ball.
Yes. I call it time and an experience, right? They're a parallel path. Time and an experience. And I have a similar story. When I was in high school, I played basketball, and so we would join the 3-on-3 league that would be playing in our high school gym in the evening. And me and my buddies, there was 3 of us. Wow, for a 3-on-3. And all the guys in there were, they had, you couldn't see skin. There was so much tape and wrappings and ice, and right. If they didn't have K-tape, or is it?
Yeah, K-tape. Yeah.
They didn't have it back then, but back then they all looked like mummies, right? I mean, they're at my age now, so they were really young now that I'm at that age. But at the time, they look really old, and especially since they're playing basketball as mummies because they're so wrapped up. And I kid you not, almost every single time, I say almost, because it's not time and experience doesn't always win. But the majority of the time it wins, and they would clean house. We would lose. We were young. We were more energetic, right? We could last longer, but that was the problem. They knew that. So they would move the ball. They had time and experience. They were better shooters, so they never drove. We always drove, right? And so it was just this time and experience, and it's frustrating. And so that's the same thing here. You got time and experience. You got money to back up time and experience as well. And so we're not saying that don't do this stuff, right? We're not giving advice or anything like that. It's just, you need to know what you're getting into. And so as we go through this, I think the basics of things is really just, okay, these are all assets that they're providing us, right? So what's an asset? It's an asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. Okay, that's the definition on Investopia. Sorry, Investopedia. I went Disneyland on us,
That's a new website, Bob. Let's
right?
do
It is a
it.
wild ride, you know.
Investotopia. It's like it's the utopia of investments.
Assets are reported on a company's balance sheet and are bought or created to increase a firm's value or benefit of the firm's operation. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, or improve sales, right? So you hire a salesperson like we have just done. We hired an asset. She is designed to help us improve sales. Now, the company is investing money in her. So it is an expense to the company to yield a cash flow and improve sales. Basics of assets. Okay. So this is important to understand. Then the flip side is understanding what a liability is. Now, hopefully, I want to go through this because I think a lot of people don't understand the very basics of this. Mm-hmm. And it's important because when we start talking about the financial distributors, you need to know what this means. A liability is something a person or a company owes, usually a sum of money. So you owe this to somebody else. Okay, so think about your mortgage, right? You owe money to the bank. That's a liability. So, but no, Bob, my house is an asset. It's an investment. No, it's a liability. That's it. Sorry, because it's not creating cash. Well, it's appreciating. Yeah, but you don't have access to that equity, which, by the way, doesn't generate a rate of return. You don't have access to that equity unless you do what? Refinance, loan, or sell it. Then it becomes an asset, right? But living in it, it's a liability. Okay. Now, liabilities are settled over time through the transfer of economic benefits, including money, goods, or services, right? So I could owe somebody a favor, right? I could have borrowed their lawnmower. I owe them something, right? It's not dollars, but they did me a solid. And so if they come to me, it's really upon me to say, yes, I will help you with this when they come to me because I owe them. Right? Recorded on the right side of the balance sheet is the liabilities. It includes loans, accounts payable, so what you're going to pay them, okay, mortgages, deferred revenues, bonds, warranties, and accrued expenses. And the one thing I want you to understand are these two things right here, bonds and warranties. These are investment structures that investment companies use. Specifically, Warren Buffett uses warranties a ton. This is how he bailed out Goldman Sachs in the financial crisis, to where he can guarantee himself a rate of return because they owed him. Okay. And that's not for this episode, but so it's important to understand that. So, all right, now that we got a little bit of little high school education in us, which we should have learned this in high school. Maybe we did, but we were not thinking about that. We were thinking about going to play soccer or basketball or whatever we wanted to go do, or our girlfriend. Sorry. So let's talk about banks. Let's talk about leverage. Okay. And Joe, chime in at any time, of course. So if there's something I say that you want me to clarify to help our listeners, then awesome. Just jump right in.
Cool.
All right. So this is important. This is from Fred. Like, who's Fred? He's not the guy down the street. Okay. This is the Federal Reserve website. Okay. So I'm gonna get out of here and I'm gonna go into my. Okay. So Fred, this is what the Federal Reserve. What is Fred? Now I'm not going to just tell you. I want to go into. Hello. What is Fred? So you guys don't take my word for it. You hear it from somebody else, meaning the Federal Reserve. Fred is short for Federal Reserve Economic Data. This is their information. Fred is their AI before AI. Okay. So this is where all of the Federal Reserve data is at. Now, I'm bringing this up because I find this very, very important. Look when the last time this chart was updated. What's that? Do you see what that date is? What's that date, Joe?
2012.
2012. Okay. Now, look at this. I'm going to click on max. Did you notice anything change?
I didn't see anything change. But
Nothing changed. We are looking at the max. What's the last year up here? What's that year?
So what? 1949.
Yes.
This is the data that they're basing, or
This
what they're presenting for people who are just listening. There's a chart that goes, it looks like it starts in 1916-ish and then goes up to the last one is 1948, and I think it goes up to 1949, and the chart is the same, and that's the max data set that Bob is choosing on this website.
I'm not choosing, it's what it's giving me.
It's like showing it.
Yeah.
And
yeah.
you can't change those. You can't.
Nope. No, I can go lower. I can go 10-year. This is the max. This is the longest. Now, why am I showing this? Because there's data that they don't collect anymore. Even though this is your trusted data source since 1991, which is what it like says on their website.
Decades after the data is available.
But what is this? And here's the thing. What is this chart charting? What is the data?
It says cash reserves, yeah,
of the Federal Reserve Bank for the United States. What's that mean? They stopped charting cash reserves in the Federal Reserve back in 1949. When did income tax start? Right around this date.
Was it really?
Yes. Okay.
Wow.
So this is important. I guarantee you. Now, I found this morning. I'm going to be completely transparent. I found this morning. I'm as shocked as you because I'm like, I gotta show this because the next site I'm going to show you is what I wanted to show you. That's what I was looking for because I wanted to see if there was any data that changed. Okay. Now let me come back to my PowerPoint here and let me show you something. All right. So now we're back at the PowerPoint and we're looking at the Federal Reserve chart. Now, what this is that on the left side of this chart, it says liability type. Okay, what was a liability definition? What we owe somebody else, right?
Right.
Now, why would we say a bank has a liability? Who would they owe? Well, think about this. A bank doesn't owe anybody. What is a liability to a bank? Cash. Cash deposits sitting in their account. Because why? It's not earning anything. They can't lend it out.
Just sitting there.
Just sitting there. So what's this date, Joe?
2018, it looks like. 2018,
right? So January 18th, 2018, not 1918, 2018. If a bank has more than 122.3 million at the time of this chart, 2018, they were required to hold 10% of deposits as cash. Okay, so that means 90% of the money they can turn from $1 to 10, fractional lending, right? All right, now this is important. How does a bank make money? Lending, right? It's the interest, right? Banks are probably ecstatic. Interest rates are going up. Do you think the Federal Reserve and banks, and I'm not saying this is what happened. I'm just posing a question. This is the cynical black helicopter person in me. Do you think the desire, because interest rates were so low since 2008 to now, do you think the Federal Reserve, the banking system, worked with the government to over leverage and over lend money to create inflation? Because inflation causes goods and services to increase. It forces the Federal Reserve to increase interest rates to slow down the flow of money or liquidity. But interest rates are it's revenue. It's a rate of return for a bank. Do you think that is possible?
Yeah, I mean, I got a black helicopter guy inside of me too, so.
right? And 90% they're able to leverage at that. Now, leveraging 90% at 2% rate of return or interest, right? Mortgages went like crazy, right? And so, in fact, the financial crisis was because of mortgages and lending and all this other kind of stuff, right? Fractional, nothing's really changed, right? We didn't learn our lesson. What do I say about history? Either you learn from history or you be history, right? And so a lot of people are being history right now. Things are changing back to what they were before the financial crisis. So now let's take a look at what happened in March 2020. Do you remember what happened in March 2020, Joe?
Well, everything shut down.
Yeah. COVID, right? Everything shut down. Here's an interesting thing. Okay. This is from the Board of Governors of the Federal Reserve System, meaning this is each Federal Reserve location has a governor, so to speak. This is all of them. As announced on March 15th, when did the world shut down?
Right then.
Conspiracy, black helicopter. Now there's like 3 or 4 above me right now. The board reduced reserve requirement ratios to 0% effective March 26th.
Wow. Meaning they don't have to hold any percentage in reserve.
None.
So it's now infinite.
Yes.
Like they accept it. They can just basically give money.
Yes. Dollar for dollar.
Wow.
Transaction account, no liability.
If you're just listening, Bob's got a screen that says reserve requirements, and it says net transaction accounts percentage of liability 0 effective March 26, 2020. Wow.
So what this means is that every dollar you deposit in the bank, on the back end, they are lending it out. They don't have to. So when we were worried about, right, when these banks in San Francisco started going down and shutting down, what were they worried about? Run on banks. Why? There ain't no money.
Because there's nothing there. Right.
Very interesting. All right. Now, that was that system, banking system, leverage. Okay. Any questions before we move on to investment companies?
No. I mean, yes, a million, and no, not that we have time for.
That's right. We could be here all day. We are now a Joe Rogan podcast. We're gonna be here for 6 hours. If only, right? We could be Joe Rogan. Oh man. Maybe just dropping his name in this will get us a few more listeners.
There you go.
An investment company is a corporation or a trust engaged in the business of investing the pooled capital of investors in financial securities. Pooled investors, what's that mean? That means everybody on your neighborhood gives and puts in $1 into this corporation or this trust. That $100 from each of the people in your neighborhood now is a pooled capital investor. Okay. This word pooled is very important, and Warren Buffett uses it very well with insurance companies. And we'll maybe talk a little bit on that today. Maybe we'll save that for another episode, talk about insurance flow. Okay. Now, keep on with investment companies. This is most often done either through a closed-end fund or an open-end fund, also referred to as a mutual fund. Okay. So what the heck is this, right? Again, this is not investment advice. This is just education. A closed-end fund is when you have a pool of money. They say this is all the money we're going to have. They close it up. And then the value of that, the pool of companies within there, then companies that pool of money invested in, there's no new money's coming in. There's not creating more and more money going into it to devalue, so to speak, your return. Open end does just the opposite. Okay. So which is kind of hard to understand, because if you have a popular mutual fund, you have more and more money going into it. They have certain requirement to have that money be invested. So just the focus and the rules of a mutual fund actually can devalue your investment because of the amount of money they're collecting. Right. In the rules that are there. So I'm not saying that's bad. I'm not saying that's good. It's just, interesting. In the US, most investment companies are registered with a regulated by the Securities Exchange Commission, also known as the SEC, under the Investment Company Act of 1940. Okay, so our country went through what in the early before 1940?
Right.
It was almost
Dust
the end.
Bowl and right. Yeah, I mean, crazy.
Yeah, we were this close to being not a country,
Mm-hmm.
right? Staying Mexico and Canada, right?
Right.
Um, now, registered companies means that they are registering with the SEC and they're saying, hey, we're going to abide by your rules and regulations, and we're going to allow our investments to be offered to non-accredited investors. But I also, as a registered company, am going to abide by the reporting rules and regulations of the Security Exchange Commission. Why is this important? Because most of these registered products are sold by financial advisors or people with a license that have taken a class, have passed an exam based on the type of an exam to allow them to go to the public and sell this product or these services, distribute to individual non-accredited investors. Okay. An investment company is also known as a fund company or a fund sponsor. Okay. They often partner with third-party distributors to sell mutual funds. Exactly what I said. All right. So let me get out of presentation mode and let's go to a website. All right. Let's see here. Mutual fund. Let's go to Vanguard. Okay. So I have Vanguard up. I clicked on personal investor. And then I get to this page here and I want to look at, okay, what this is Vanguard's website. So I want to look at this and I'm saying, okay, I want to know about investments. Okay. So I go to their website. Oh, shop our products. What do they say? Products.
Yeah. Shop our products.
Yeah. Interesting language. Not invest.
Mm-hmm.
Shop. Be a consumer. All right. Interesting. So let's go in. All right. Now we get to another part in products and services, and I'm going to choose mutual funds. Okay. And then what I'm going to do is I'm going to click on where it says view all Vanguard mutual funds. Okay. I click on that. Now we have all their mutual funds. The 500 index fund Admiral shares. This is kind of their main one. It's a risk factor 4 out of 5. So it basically invests in the S&P 500. Okay. I'm going to click on it. I'm getting to a point here. Okay. Now, what's nice is that when you buy products, what do? You usually look at the label, right? You look at, is this what you want? So they have some information off to the side, some statistics, what kind of product this is, where it's invested, why, all this kind of stuff. But I want to go down to the bottom. And it's on the bottom. It's not at the top. It's at the bottom. Okay. Can you see this, Joe?
Yeah, I can see it.
Can you read that for everybody?
I can. I'll use my best reading voice. The performance data shown represents past performance, which is not a guarantee of future results. Investment returns and principal value will fluctuate so that investors' shares, when sold, may be worth more or less than the original cost. Current performance may be lower or higher than performance data cited. Performance data do not reflect the deduction of $25 annual account service fee that may be applied to certain accounts. If this fee was included, performance would be lower.
Know what they get to do? Check off the compliance box that they told people that there's risk. Right? And they say it, not a guarantee of future results, past performance. So what do they tell us all about? Past performance. That's what we make decisions on. That's where Morningstar comes in and gives them a rating 4 or 5 stars, 2 stars, 1 star. You look at performance, year-to-date performance, 20.76%, right?
Right.
And then we decide, hey, let's do this, right? Plain and simple. But we purposely, willingly, and knowingly go into this knowing, or do we, that we're not going to make money. Not that we're not going to make money, that we're not guaranteed.
There's the possibility, right?
The possibility. Okay. So, but what if I I just find this curious. There's so many different ways I can take this, but I won't, because that I don't think that's purposeful for this this conversation. But I just find this to be of interest when we go down this pathway and we look at this.
Well, hey, this episode took a little bit longer than we normally go, and so we're going to break this up into 2 episodes. So make sure to come back for the next episode, where we're going to continue the conversation about the financial distributors, the roles and the guidelines of financial distributors, aka how the banks, investment, and insurance companies work. See you next time. If you want to be part of the conversation, join us over on our LinkedIn and Facebook pages. Leave a comment and let us know what you thought, and more importantly, what questions you have. So until next time, take everything that you've learned today and go implement it in your life. By the way, let us know how it's impacting you.